So I go to a lot of demo days because I'm an investor, and I'm always looking up on stage and I'm seeing these entrepreneurs giving their pitches. They've got like 2 minutes or 5 minutes. It's very high pressure. And I always think to myself, you know, that looks like it's pretty hard. How many of you guys out here have pitched in a demo day before? How many folks have pitched in it? Yeah. Walk in the park, right? And the worst of all is you got an audience full of investors and you're wondering, how on earth do I get their attention? Well, I thought to myself, what would happen if we flipped it the other way around? What if instead of having entrepreneurs pitch to investors, we had investors pitch to entrepreneurs? Let's give investors a chance to feel what it's like to stand on stage. So this is Silicon Valley's first reverse demo day. What I've done is gathered together a group of brave investors who volunteered to face the audience of entrepreneurs. Each of them will have 5 minutes to pitch themselves and their firm to try to convince you as to why they're the right folks to take money from. And at the end of that process, after everyone has had a chance to pitch, we'll then open it up to general questions from the audience before we open it up to networking, which, after all, you guys, when you have a bunch of investors captive on stage, is exactly what you want to do. So without further ado, let me go ahead and introduce the first angel investor who's going to pitch, Jeff Clavier of SoftTech Ventures.
Thank you. So let me just check this because I didn't. You always want to check that the remote control is working. So where do I point it out? Over there? Okay. So, welcome to the first ever, and maybe only, reverse demo day.
Depends on how you guys treat the investors.
That's a hint if you want to get investors to pay attention to you. Quite a joke. So, SoftTech, we've been funding Web 2.0 since the beginning, almost. Meaning that I started investing in Web 2.0 companies back in 2004, and I traced back the beginning of Web 2.0 to 2003. So, what we want to hear about as investors is the team. So let me introduce you to my team. First, myself, besides the fact that I'm French, I used to be a C developer, that not many people sort of know that. I run very large engineering teams. I built a startup in the financial services market. And then I made the move to the dark side about 12 years ago. Then left in 2004 to start SoftTech. Then became an angel, super angel, micro VC, whatever the hell people sort of call us. And I'm at Jeff on Twitter. My team, Charles Hudson, my partner, who joined me about 18 months ago, is one of the best business development guys in the Valley. He's done sort of the reverse. He was a VC, then went into being an exec in a few companies, became an entrepreneur, and a micro VC. He's the crazy one. He's actually the guy with 2 full-time jobs. He's both an entrepreneur with his own startup and my partner at SoftTech VC, which means that when he actually gives you advice, it's not what you read from books or heard or read on TechCrunch. It's something that is living and breathing every day. Very important. Steph is our marketing expert. She comes from the brand and CPG marketing world, and she dabbled into angel investing in New York before moving to the Valley. She's awesome. She's looking after next-gen e-commerce for us, very relevant. And Ashley is actually the one who makes everything happen at SoftTech. She's our Uber executive admin. So that's the team, 4 of us. At the end of the day, we are actually a startup, and that's the way sort of I look at it. I started in 2004. I actually bootstrapped it for 3 years with my own money, investing about $1 million in 20 startups. Then I raised my first round of financing, which was my first institutional fund, in 2007, which was a $15 million fund, one of the first micro VC funds. We proved our scalability and the revenue model of a micro VC, and then just raised our larger round, which was a third fund, which was 55 million. And we hired a team. So very much like a startup, from bootstrap to initial financing to larger financing. Big difference, the VC market was my real sort of market target. As you guys sort of try and focus on the big market opportunity to disrupt, I was after the VC market. And what enabled SoftTech and the rest of the micro VC ecosystem is the capital efficiency, which allows you guys to start a company and get going and prove that you have something for, you know, a couple $100 grand, where it used to be sort of 5 million. We've funded 110 companies since 2004. Those 110 companies have raised some follow-on financing, 60 of them, and we've raised about $800 million in follow-on financing. That sort of gives you a sense of the success of some of our companies. This is our focus area. So we do essentially consumer internet and mobile. Next-gen commerce, mobility, and cloud are really sort of the three main sectors we invest in this fund. And if you look at the progression of the size of our investments, we're not doing 250 to $1 million, but typically we try and get in 400K per investment, and we will try and get 5 to 10% of the company when we invest. This is how we're geographically split. So if you're anywhere in the middle except Boulder of the US, you're screwed. But otherwise, if you're in the valley, you're fine. And no, we don't do anything in Europe. I mean, it's 2%, but whatever. It's like 2% Europe, 1% Canada, what can I say? In terms of track record, those are the guys we had the opportunity to work with and kiss goodbye to through an acquisition. Most of the time we get cash, sometimes we get stock. That was the case with Twitter, Facebook, and Groupon. So we did well on those. This was Fund 1, this is Fund 2, this is Fund 3. And in terms of sort of the value add, those are the 5 things that you guys are looking for. And yes, money is the number one, but it's actually, sort of I wouldn't say the most commoditized sort of aspect of the 5, because yes, you need to have money if you want to be an investor, but at the end of the day, that's not the most important. What matters is the value that you add. And so in terms of expertise, we've built or helped build 115 companies over the past 8 years. And that means a lot of success, a lot of failures, but most importantly, a lot of lessons. You want people to be involved, and despite the size of our portfolio, most of our entrepreneurs, all entrepreneurs will tell you that we're extremely active with them. We just figure out how to really sort of be extremely involved without spending, 4 hours, 5 hours, 6 hours with you every week, like some of the traditional VCs are doing to keep busy, or give the impression to keep busy. We are only and solely seed investors. We've been doing this for 8 years, and for us, when we invest at the seed stage, it's not for optionality reasons because we want to raise, or have you raised $5 million from us later? No, we do seed. We don't invest because it's now really cool to be an angel investor and you can name drop the companies that you've invested in. Oh yeah, I invested in, No, we don't do that. We are the guys who will help build the companies. And at the end of the day, if you look at the companies we've invested in, we only invest with the best co-investors on the seed side, and we bring the best VCs on the Series A, Series B side. And that's really what you want. Because at the end of the day, in a world of oversupply of capital in the valley, you really want to get people who can add a ton of value. And all things being equal, that's where you will try and get the people you will get investments from. How to reach us? Yes, I'm here, but you shouldn't talk to me here. What you need to do is to find the guy who knows you, who knows me, who will make an introduction. And that is really important. If you take something away today in the hour or so we spend, that's the one thing. You basically find that contact we have in common who will use his credibility with us to introduce you and pitch you. Why? Because if you don't do that, we get 20 to 30 opportunities a day. And if you get referred by someone we trust, you'll get to the top of the pile. If you send a cold email, you'll get to the bottom of the pile. And being at the bottom of the pile really, really sucks. Why? Because at the end of the day, we've seen maybe 10,000 deals in 8 years, or more. I don't even know, to be honest. Guess how many cold deals we invested in 8 years? How many? You heard me saying. So it's really super important to not play the odds and say, I'll be the cold email you will invest in. Doesn't happen. You want to find, and that's true with me, that's true with any of us. So you really want to find that person who will be in the middle of that food chain and will sort of help you get the intro. A few tips, that's the bonus. Do your homework. It's always unbelievable to me that entrepreneurs reach out to people who have an investor badge not knowing what they've done, who they are, what they've invested in, and even if they're relevant to them. Yes, I invest, but I invest in a very specific set of companies. So if you do anything in the medical space or enterprise space or whatever, I'm not your target. Don't waste your time with me. Read the fucking website. We just spent 20 grand redoing our website. It's because it's supposed to help you figure out what we do and how to, reach out to us and so on and so forth. And, for those of us who have a Twitter account, read the fucking tweets. Why? Because it gives you a hint of what we're interested in. Get advice from fellow entrepreneurs, from lawyers, from people because the more advice you get, the better you will be at this game, which is a sales pitch at the end of the day. Crunchbase and LinkedIn are your best friends. Those are gold mines of information to find out who is doing what, how to reach to people. You want to know how to reach me? Ask LinkedIn. I'm pretty busy there. Always ask portfolio companies of the investor you want to talk to for references, either at the beginning or while you're sort of talking to them, and beware of the bias of things like the funded, because you will find that people are really pissy about an investor who says no, we'll get on the funded and we'll ravage them. It might be fair, it's fine, but don't trust the funded as the ultimate sort of source of unbiased information. For the people who have the opportunity to attend one of the great incubators, whether it's YC or Techstars, it's actually a fantastic option. And so consider it. It's really hard to get in. It's very selective. But if you are actually, you have the opportunity to get in, it's actually a great option. Get a real lead investor. What I mean by that is very often these days you have a bunch of investors being clubbed together, doing like 100K or 50K each or whatever, but no one is raising their hand saying, this is my deal. I will actually lead it and I will work with you to help make things happen. Because when the shit hits the fan, and it always does, you want to have people who are deeply involved and motivated to help you. I said that already. Focus on the value add. There's a lot of celebrity investors roaming around saying, well, I can, have 1 million Twitter and I will get you, traffic. That's bullshit. Yes, having someone like that can help, but it won't make the company. Investors who live and breathe and support you every day will be the ones helping you make the company. And this is sort of just a reminder that being an entrepreneur is really, really hard. It's, sweat, blood, and tears. And so deep passion is the only way to survive, the 5 to 7 years that it takes to actually get something from inception to exit. And so it's not something that you think, it's something that you feel. Good luck.
Thank you, Jeff. And as you guys have probably noticed, due to scheduling conflicts, Dave McClure was able to make it here today. Our panelists have all agreed to swear as much as possible to make up for that difference. So now who I'd like to call up to the stage is Carol Sands from the Angels Forum. I know that Carol might need to get going early. Hint, hint, you guys write down her contact information. I'll turn it over to Carol.
Thank you.
Thank you.
Hi, it's nice to see so many people here today. So the Angels Forum is a very different type of angel group. Most of you are familiar with the dinner or lunch meetings where you go. There are a lot of people in the room, and typically as the form of entertainment, they put up 3 or 4, maybe 5 or 6 different entrepreneurs, and then at the end of the meeting, boom, it's done. That works if you're looking for experience at how to be able to present. It helps you go look for what I call a champion angel, which will do those types of introductions that he was just talking about. But when you're ready to be funded, I hope you'll think about us. So we're a very different angel group. We're limited in size, and we are a work group. All of us considered working for a venture fund, turned it down, and decided that instead of working to invest somebody else's money, what we were going to do was invest our own money. But we do it in a work structure. So we meet every week, and we have a management company that handles all the administrative stuff. And the members, and there are only 24 of us, do all the work. We don't have associates to pass work off to. There's work to be done, we do it. So the group is a kind of a blend between a venture fund and an angel group, which turns out to mean that you end up having investors who are very committed to your success because it's their personal money. And trust me, we care. So we invest as a single entity, but in the process prior to investing, we're doing due diligence and sharing that information actively within the group. And the concept is all of us have different backgrounds. Getting all of us to say, oh yeah, that sounds really interesting, is virtually impossible. We've been doing this since 1997, and we have yet to agree. It's just, the nature of how investment works. So, but when we hit a high level of agreement, which means that like maybe 4 or 5 of us like it, well, it's just a very diverse thought group. So what happens is that we make the investment, but then the whole partnership owns the investment, which means that we have a one for all and all for one kind of mentality. So if I make an investment in a portfolio company and one of my partners has an expertise that I need to apply to this portfolio company, even though that person isn't an investor in the company, they do the work. And they do the work because tomorrow roles will be reversed. We typically lead. We typically set the valuations. We take the board seats. Quite frankly, most of the time we're building the board. And we're very selective. We know that the most obvious failure for a startup company is just simple, the entrepreneurial team couldn't execute. But we think our due diligence process is strong enough to eliminate that risk. So the next 2 is that you have a really bad board of directors. So we care about who your board members are. And you don't have enough money. So we care about who we co-invest. The key thing is that with us, we're investing a lot of time. And quite frankly, all of us are in a point in our life where we can go make more money if we needed to, but we haven't figured out a way to go get more time. So we're very careful about how we invest our time. What we're looking for are companies that are specifically local. You have to be here in the Bay Area, and quite frankly, if you're within a 2-hour drive of Palo Alto during rush hour, I love you. You have to be really amazing to get me to go up to Santa Rosa or over to Santa Cruz, and the reason is that we value our time, and we're lucky enough to live here in the Bay Area where there is a nice concentration. I've listed out the things that we're looking for, but the most important one is the bottom one, which is the alignment. We want to make sure that at the beginning, everybody is aligned. If we can't start off that way, we have no prayer of getting there over time. Our investment focus is really diverse. As I mentioned to you, there are 24 of us. We all come from different backgrounds. The truth of the matter is, what we really love are companies that are going to make us money, companies that will make a difference, And when you kind of sort on a very simple criteria of, is this product or service a must-have or a nice-to-have, we prefer to invest in must-haves. The EdTech one is a relatively new industry in Silicon Valley, and we're really excited about it. And we have a couple of old investments in this area, but we're too far in front of the curve. And so we're actively looking to participate in this new industry. Here's my contact information. I have 23 other partners. I hope you'll go to our website, figure out which of the partners is the one that probably will match up with your area of interest. And despite the fact that everybody's saying cold calls don't work, we actually do try to sort through, maybe not as quickly as you would like, but we do try to sort through what comes to us. Having said that, the introduction really is a magnificent way to get to the top of the list. And the most likely person that each of you can get to do the introduction is your law firm. So I wish you good luck, and I hope to hear from you if you're in our investment criteria.
Yes, Carol does send her apologies. She does have to leave a little early today, but she gave you her contact information. That's the most important thing. And apparently she does respond to cold calls, though maybe not in a timely fashion. Before we move on to our next presenter, I had a request to provide information about the Wi-Fi password. Has everyone got the Wi-Fi password? All right. I unfortunately got an email from Chad saying I should provide the password. The password did not come through. What is the password?
It is on the screen now.
Excellent.
They're all numbers, by the way.
I'll give you guys a few moments to write that down in case you want to tweet or otherwise communicate with the outside world.
Oh, it is what's on there? That's correct? Okay.
All right. Now moving on to our next presenter, and I think hopefully these presentations give you some sense for how diverse and broad the angel community is and the different ways that they work. The third presenter we have today is Steve Schlenker from DN Capital. Come on up, Steve.
First, in honor of Dave, this will be the fucking worst presentation you will ever fucking see. Literally, I've put this together for a bunch of other slide decks, so I will try to go through this very quickly. Oh yeah, very bad. So who are we? Basically, we're a venture firm based out in London with myself as the seed flag here in the Valley. We invest in companies where there's an opportunity to bring them across Atlantic. So most of our companies happen to be European companies we bring to the US. About a quarter of our companies are US companies where we think we could bring them into Europe. Two main partners, we've known each other for over 20 years. We've been in private equity for that long. That's pretty important because if you're going to take money from an investor, you don't want what we call VC tourists. So you don't want people who were an entrepreneur and they say, let's dabble in venture capital, and then 3 years later they say, you know, I'd really rather be an entrepreneur again and go back. You don't want someone who came from investment banking and says, oh, it'd be more fun to be a principal investor, and then realize it's actually a lot of hard work. You want someone who's been doing this for a long time, who's made mistakes, and then basically learn from that and can leverage that so they don't have to make the same mistakes with your company. This is really a shit slide. E-commerce, online communities, media, enterprise, mobile, that's where we invest. Okay, so three slides very quickly about portfolio companies and what we did to add value. 3 slides about areas that we like to invest in. So this was one of our portfolio companies, Shazam. We got involved very early. There was a venture tourist in there before. They left. The company was on its ear because they weren't getting money from someone who was already there but had left. We came into the company. We added from our own network 6 of the top executives. including the person who was going to bring them into the US. We introduced her into Apple. She in turn won the Apple account, which brought Shazam into a new plane of existence. Today, Shazam has 200 million users. It is the fourth most popular app of all time in smartphones. And afterwards, we're able to bring in people like Kleiner Perkins and IVP, who can add even more value, hopefully, going forward. A nice quote from the CEO, basically saying, these guys don't just work hard, but they work effectively.
Video, apparently gesturing with the microphone hand is causing audio. Gesture. Transfer the right hand gesture.
Shit presentation, sticking with a theme. Okay. Endeca, a company that we got involved with when it had 4 customers. One of their customers happened to be in Europe. The entrepreneur invited us into an oversubscribed round. First thing we did, we introduced him to more customers. Won his first $1 million account globally through a direct introduction we made to the CEO, which was in Europe. Still one of their largest customers today. More importantly, when they're ready to exit, we had just sold the company to the person who had given them a term sheet. We're able to walk the CEO through what they were going to look for in terms of their requirements on an exit. We're able to pull off a $1 billion exit in 90 days from term sheet to closing, which is pretty rare for a deal of that size, even though we were probably the smallest institutional investor in the round. And a nice quote from one of our co-investors over at Bessemer. Dynamic example of us sticking with a company that got into hard times. Business really was floundering after about 3 years of operations. We took the CFO and said, you really know this business well, you should be the CEO. He thought about it and ultimately decided to do that. We put in more money when the company was effectively 3 weeks from running out of cash. Also re-incentivized the management team with carve-outs. Eventually they put more money in personally because they wanted a bigger stake. And we sold out a very large multiple, not just for ourselves, but for the management team. So what are some of the themes that we like? One of our European themes, people talk about e-commerce. E-commerce is very geography specific. Right now in the world, one of the best geographies for e-commerce is Germany. Why? Because post the City Deal acquisition by Groupon, people realized in Germany, hey, I should actually use a credit card to buy stuff online. In the past, they either didn't use credit cards or were afraid to use them online. Offline, the stores are really still World War II quality, really shit stores. So people want to buy online. The delivery network in Germany is one of the best in the world. So this is an example of a company of ours that we backed, which goes after early childhood, it goes after products that are sold to young mothers for their newborns. We invested as a seed investment, Q4 of 2010. The graph's slightly out of date. As of this month, they're on a $3 million monthly revenue run rate. So after about a year and a half of operations, gives you an idea of what Germany looks like today for opportunities. I should mention, by the way, just going back there for a second, Otto Group, which is someone you may never have heard of, is a $14 billion group, and it's got almost $5 billion of online revenue in Germany alone. Second area that we like, we think 2009, 10, 11 was all about customer acquisition in the mobile space. We think 2012, 13, and 14 will be about lifetime value of customers. So we're really keen on finding businesses that are going after how do you increase lifetime value of mobile applications and their customers. And again, this is a company that we invested in San Francisco in this case. A French entrepreneur, we're going to help bring them over into Europe. And their value proposition is how do we use behavioral targeting to get people to come back when they've stopped using your mobile application. Finally, this is an example of some of the traction we've had with Shazam because we're moving them away from just music into television. And anyone here who watched the Super Bowl, what you probably saw was about a third of the commercials were Shazamable. The halftime show was Shazamable. In the game, you could hold up your mobile phone and get all the player statistics in real time sent to you. So over the next year or two, you'll see a lot of third-party integration between what's going on your mobile phone and your TV set. Shazam will be leading that charge, but we'll be looking for other things in that space. And that's the end. So sorry, it was a bit of a hodgepodge of shit and more shit, but that's in honor of Dave. Thank you very much.
Thank you very much. And that I must admit that you have done very well to keep the flame burning for Dave. Much appreciated. All right, we're going to go ahead and move on with our list of investors. I see just going in order to the left of me is Mark Sugarman from MHS, and let me turn it over to him.
Hi, I'm Mark. I run a boutique fund. It's about a $35 million fund. My associate VJ is here as well today. We typically invest in companies raising $500,000 to about $2.5 million. Our strategy is to work very closely with only a couple companies a year. So we generally make between 2 and 4 investments a year, and about 50% of the time we lead. We generally invest about $500,000 to $1 million, and we like to act with the same degree of conviction that our entrepreneurs do, and limit the number of companies that we get involved with, so that we can have the time to actually help out, join the board, or at least as a board observer. I started the fund in 2007, been investing in companies since '96 when I left Stanford, built a bit of a track record as an angel investor, but had a fairly different strategy than a lot of the micro angels or smaller funds here in the Valley. I really stuck to investing in 1 or 2 companies a year, began to ramp up how much I was investing per company, and began to lead deals and sit on boards. The fund's investors or limited partners are primarily high-tech entrepreneurs, founders of companies like PayPal, StubHub, Right Media, TellMe, Zappos, Yelp, etc. That helps on a number of fronts, but most importantly, active involvement with our portfolio companies. That means anywhere from they're just a lot more likely to return my calls and emails because I have their money, to sitting on the board, advisory board, or co-investment. We invest pretty broadly, so it's about 50% enterprise and 50% consumer. We have companies here in the Bay Area, Seattle, LA, DC, Finland, and Israel, so we do invest on a global basis. And we think with things like Skype and other means of communication and deep relationships that are established through a long period of getting to know each other, it's really, we can work effectively in doing so. In a lot of cases, the ties that we bring here in the Valley are more valuable to the companies outside the Valley. I think one of the other things that sort of distinguishes us is that we are generally looking for companies and entrepreneurs that want to hit home runs. So we are looking for big exits over time. We're comfortable with starting modestly to the extent that the company doesn't reach the full potential or the market doesn't turn out to be as large. We are okay with smaller exits, but in general, we are looking for companies that can be quite large. And we're willing to stick with the companies through thick and thin. Generally, the way that I put it is we're there, whether we want entrepreneurs to judge us as to whether they feel comfortable and want to call us on Friday night at 10 p.m. when they have a dispute with a co-founder, have a major business development deal, or looking at a financing prospect. And if we are their first call, we know we're doing a good job. We generally will not have, our job is to lead people to experts in our network. I think if you've been out of the operating business for more than 6 months, the tactics change so quickly that we really rely on the people who are there in the field, and we try to stay close to them. And it's our job to put you in touch with folks that can help with customer acquisition, SEO, SEM, all sorts of things in terms of choosing your tech stack, finding advisors and mentors for young founders. We generally are looking to back founders who we think can take the company all the way through an exit, and typically we are still shooting for IPOs. Our last couple of investments are in companies in the local and mobile space, and I'll open it for questions afterwards. Thanks.
All right, so as we proceed through, continuing in order, let me introduce Bruce Schechter from the Band of Angels.
Good morning. Again, I'm Bruce Schechter with the Band of Angels. The Band of Angels is actually has the honor of being Silicon Valley's oldest organized angel investor group. The group was formed by 12, I guess they were all gentlemen, back in 1994. And for every month over the last 18 years since then, we've reviewed deals and been working with investors and making investments. A couple of just fun, quick stats. Over our lifetime, we've done 240 investments in companies, and some of the results of those are, over the years, 9 IPOs and 54 acquisitions. So hopefully we can keep up that trend. And to give you a sense of our rate, over the last year, we did 25 investments. 13 of those were new investments in new companies, and 12 were re-ups in the existing investments that we have. You know, when you do a pitch, you're asked to differentiate yourself, and I tried to think about our unique differentiation. It's a tough crowd to be differentiated against up here, but we pride ourselves in the mentorship concept. And I'm going to kind of circle back to that concept in a number of ways. Even in the early stage before we've met you to make an investment, we do some mentorship outreach. For example, our organization, we do mentor days where we open up. You can just sign up, come in, and we bring in many of our members, and we'll get together at some big room like this, and we'll spend 30 minutes per person and get to know you. If you've heard about you've got to find a direct connection into an organization, and if ours, for example, if you were not able to find one directly the hard way, that's another way to get there. Now, when we do investments, in every case, we will have at least, in our case, we have 135 members of our group, which is another great asset of our organization. Every one of these members is either a former executive in the tech world, or actually the majority have either founded a company or led a company to exit, or both. In many cases, they're serial entrepreneurs who've done all of the above. So once we make investments, for us to do an investment, multiple of our members have to have decided to contribute money into the investment. And out of those investors, at least one, if not more, is going to spend quality time with that company, either as a board member, board observer, advisor, et cetera. Let me talk a little bit more about that breadth. Now, given that the lecture's been given to you all over and over that the best way to reach us is through warm introductions. Well, when you go to LinkedIn, as Jeff inferred back at the very beginning, your odds of getting to one of 135 people are maybe a little better than getting to a smaller number. So when the time comes, I welcome you to try to work that angle. As for our thesis, what are we looking for? We think of ourselves as industry agnostic, but with a tech penchant. So we actually have four different special interest groups within our organization. We have a life sciences group, we have an energy/clean tech group, we have an internet group, and a software group. So any of those realms are of interest. If you're in those realms, come and look for us. We see lots of deals every month, and we will screen those down to 3 that will eventually be invited to come and do a formal presentation with us. So back to that mentoring angle, I will offer you that I get a lot of feedback from companies who've come through our screening process. Obviously, the happiest are the ones that get an investment, but even the ones who have failed to achieve the investment have valued back to mentoring that happened along the way. We do, for the companies that are lucky enough to come and actually do the formal pitches to us, we actually do several phases of coaching and consulting with those companies to get prepared. Because our members' mentality is, we want you to be really prepared before you talk to us, because often there's a diamond in the rough, and we want to help make sure the diamond is clear and get rid of the rough. So for us, we're typically as a group, and when we make an investment decision, we're looking to deploy something in the vicinity of a median of $300,000. And it can range anywhere from maybe even lower than 200 and sometimes even upwards of $1 million or more. So often the best thing is to find one of our members who you might even convince to individually do a very small investment and then use that as a QN to come later and get the larger, say $500,000 round. We are very, very interested in syndicated rounds as well. So if you're talking to anybody else in this group but needing to fill out the round, we're more than willing to go, either lead or follow. I'll just give you maybe just some quick examples just to give you a sense of what we're about. Some of our recent exits have been Global Motion, bought a year or so ago by Expedia after only 3 years after our investment. MI5 Networks, bought by Symantec. One of the hottest ones for us recently was a company called Practice Fusion, who I would suspect quite a few might have heard of, medical records company, since been funded. Didn't take any time at all before they were funded by Morgan Thaler and Founders Fund. Talia was about, within the last 2 years, has since been funded by Matrix and Trinity. So anyway, there's a variety going on. I guess I'll wind down with, you've heard the story already, find a way to find one of our members any way you can. And the ideal scenario for organizations like ours is that if you can have one of our members already convinced that he or she is willing to invest if the rest will join, that fact alone gives you, like 10x advantage by the time you get there to pitch. So try to spend quality time developing a relationship with a person and try to build that into a commitment or close to a commitment to invest, and then come for the rest later. I guess that's it, and I'll look forward to talking to many of you afterwards. Thanks.
Thank you, Bruce. I'm now going to introduce Ben Malka from North Hill Ventures. North Hill, interesting fact, it's actually an affiliate of Capital One. So would love to have him talk a little bit about that and what kinds of deals he's investing in.
Thanks, Chris. Hi, everybody. So I work for a fund that's based in Boston, but I'm out in San Francisco. There are 3 principals in the fund. It's called North Hill Ventures. We're a bit different than most of the angel groups that are out here in that we focus specifically on the financial services sector with some ancillary focus on direct marketing. So if you are working on a startup that's in the financial technology or financial services sector, you should definitely try to reach out to us. And because we are sector focused, we tend to have a smaller group of investable opportunities. So we're more likely to take cold calls and less warm introductions. A bit of history about North Hill. We've been investing since 1999. We've made 27 investments, so we make relatively few investments in any given year, and that allows our partners to take inordinate amounts of time with the companies that we've made investments in, and we play an active role in all the companies that we invest in. We are either board members or board observers, and sometimes temporary management in companies that we work with. We have invested just about $100 million to date in the 27 companies, and they range in size from $20,000 in our smallest investment up to about $7 million in our largest investment. Each of the principals has a background that overlaps the financial services sector. One of my partners was one of the founders of Med Assets, which is a medical purchasing business, and he no longer does anything in healthcare, which is good, and he focuses on the financial services sector. Another one was a longtime VC, and myself, I was at Bank of America and a consulting firm prior to starting with the fund. And we've, like I said, been long-term investors and stay committed to the VC business. I think it's the right model. We define the financial services sector broadly. It includes, in our minds, insurance, investments, and banking, and any of the support infrastructure that works inside of those institutions. And so things that include consumer products are just part of what we do. And we try to work on industries that can benefit from early adoption by financial services businesses. So banks and other institutions have been the very earliest adopters of some of the most complex financial technologies and database technologies, and we think they're a good indication of how markets are going to evolve and can be early indicators as to where the largest sectors will emerge from. We're geographically agnostic. We've made investments in Jacksonville, Florida, of all places, and Portland, Maine, and more traditional centers like Boston and San Francisco. And as far as track record is concerned, we're probably most well known for an investment in a company that we did in New Haven, Connecticut called Hire One, and it was started by 3 college graduates from Yale, and they were 22, 23, and 24 years old at the time, and have gone on to build a company that had its original IPO in June of 2010 and is now worth $1 billion. We made the second round of investment in that company, and I think the company had they probably had about 500 customers, and they're now up to about 4 million. We were also early investors in Open Pages, Compete, and Evite. And on an angel basis, we've invested in, and this is just to give you a flavor of the kinds of investments that we look for and the sectors that we're interested in. Perk Street, Equity Lock, CashStar, Resolve, and AI Investors. For those of you who are nodding your heads, that probably means you're in those sectors, and that's a good thing. And if you've never heard of those companies, then there are probably other angel investors who would be appropriate for you. And we pride ourselves on being straightforward, easy to work with, and active in the way we get involved. So that we try to make sure that everyone who has contact with us knows where we stand, understands what we're thinking, can appreciate our perspective on their business, and has a chance to interact with us and respond to any any questions that we might raise about their business model. And the last thing I want to say is we don't do hot sectors. We think that there are other people who are better at attracting hot deals and getting involved in things that might be the darlings of the media as opposed to have fundamentally sound business models behind them. Anybody needs to reach me, you can reach me at ben.malka, it's spelled M-A-L-K-A, at northhillventures.com. And that's 2 H's and 2 L's. The website is the same. Thanks very much.
All right, thanks, Ben. One last check. Is Alex here? We had one more investor who was scheduled to present. Trying to see if he's actually here because he did not join us on stage. It looks like that's not the case. All right, fantastic. So we have a little bit of time before we're going to throw it open to networking. So what we're going to do now is to give you guys the opportunity to ask your questions. So don't be shy. If you have questions about either specifically their firms or more generally the angel investing process, I'd love to hear them now. Over there.
Hi, I'm Nathan Shore. From what I heard this morning, no one mentioned the data space, which everyone agrees is like the new Web3. And what are your various interests in that? Any one of you, sir?
All right, so the question is interest in the data space. I see Steve. He's got something to say.
So we exited 2 companies last year, one being Indeco, which was effectively enterprise BI or business analytics. The other, Datanomic, which was a company that was taking data quality and moving it into things like helping banks figure out who they should do business with. We like the data space. We like big data, analytics related. The issue for a lot of funds of our size, generally people around the table here, is that if you want to be successful in the data space over time, typically these companies require between 30 and 80 million of capital. And it just, if you look at the history, most of the companies that are successful in the space tend to require significant amounts. And that's pretty hard to commit to. I mean, even if you think that one of us might put in 5 or 7 million over the life of an investment, then we need to know upfront who's going to do the series A, B, C, etc., in order to make sure that you remain funded right through to exit. So I think in most cases, we need to have a good understanding about what that path is before we're going to make a commit.
Thank you.
Other questions? Caleb, I might have expected this.
Hi, I was just curious, you guys have a lot of experience in a lot of investments. Are there any commonalities to the most successful investments you've made in those companies?
Getting my exercise today.
You can get another mic. I think it's the combo of fantastic founders, differentiated products, and a big market opportunity that actually is something that you see early on before you invest. And if all the stars align, and never do, you actually can get to a big footprint being built and a successful company being, sort of getting off the ground. I would say that's, if you look at Mint, if you look at a few of the companies that we've backed and were really successful, that's really what we had. And what's interesting is that sometimes, you will hear, I would rather see 2 to 3 founders, but we've had very degrees of success with one founder. I mean, Aaron Patzer is a fantastic founder, and 4 founders. But it's true that when you think about building your startup and going through this journey, not being on your own is actually very valuable.
Excellent. I think I saw another question. Oh, Bruce.
I just want to repeat something I was telling to one of the gentlemen I met outside this morning is, what do we look for? The big thing that I would suggest that you all think about that is commonly underestimated is the lack of clarity on go-to-market. I hear great stories about how big the market is, how great the team is, what a wonderful product you have, but overwhelmingly when we fail because you weren't able to acquire customers fast enough. And when you prepare to go do your pitches, I would overwhelmingly welcome you to think hard about a very credible, tangible, specific story of customer acquisition.
I saw you had a question over here.
Don Fan, I heard that investors invest in the founders. Now, if you're a founder and you have an average bio background, what can you really do to increase your chance of getting an investment?
Great. So I will pass it back and forth. Don't worry, I get my exercise every day.
So I don't know what an average background is, but what I would say is have a really good idea, show a tremendous amount of energy, and be knowledgeable and willing to listen.
Steve would like to speak.
I don't really, but
Oh, okay.
I will. It's a tough question because VCs obviously want to have that risk taken off the table by being able to say, here's someone who has proven they could take a company full cycle, meaning not just they've had success raising capital, but they've been successful at making multiples of returns for their investors. And when that risk is off the table, it's easier for them to write a check in their next company. We have backed people who came to us cold from a conference, but never within the first meeting or second meeting or even over the next few months. I have a company that we recently backed where we got to know the entrepreneur over 18 or 24 months before we wrote a check to him. But it was a complete cold call the first time he met us. It didn't come through any introductions, and just gradually we got to know him, we got to know his background, we got to know what made him tick, and decide this was the right person to put money behind. So I think the reason that you find a lot of VCs will back people that they've known from their college days or that they've known from a previous company where they were an entrepreneur is because you get that intensity, that crucible of having worked closely with someone, so you get to really understand what makes them tick. If you don't have that with the VC, then you have to find another way for them to get to know what makes you tick and that you're a backable person, and that may just take time. So that's the only thing that I could say. There's no quick fix.
One, incubator is actually a great way to solve that issue. So if you can get yourself into Techstars or YC or 500 startups, that would be sort of one way. The other, to be honest, is, I don't even know what is the percentage of first-timers that we back, but I would say a vast majority of the companies that we get involved in are, the first company of the entrepreneur, and by definition, there's no track record. And so it's a matter of figuring out how passionate they are and how relevant they are to what they're trying to pursue. And this combo of the team they've built, the product they're putting together, and the market thereafter is the thing that will eventually sort of back. So there's no notion of, hey, you have to have a PhD from Stanford or a degree from MIT in order to be an entrepreneur.
There are a lot of folks who want to ask questions. We're going to try to get to as many folks as possible before we have to break.
Hi, everybody. First of all, thanks to Orrick for this great event. My name is Adriano. I'm an entrepreneur in residence at StartX. My question is about due diligence. I would like to know from you guys what are your best tips or secrets for conducting a good due diligence process.
So just to clarify, due diligence, us on you or you on us?
Very important clarification.
So what we will do is based on the market that you're entering, based on the product that you're building, because we only or mostly focus on consumer internet, we actually use the product a lot. And then we'll try and figure out who in our network is sort of an expert. And that could be someone in the portfolio, someone we know at large companies like Facebook or Google, and we'll get you and them together so we can get their views on the product, on the team, on the expertise you have, and the market opportunity that could be yielded by the product you're building. And we'll sort of put everything in a grinder, and eventually we'll balance that to figure out what we end up deciding.
In terms of diligence on us, I'd say the best thing to do is to look at who we know in common, do background checks on us, cross-reference, ask for our personal references. That's really where we make our reputation. In our case, we have a number of companies and entrepreneurs that we've backed multiple times, and that's our goal, is to build a relationship where you want to come back to us. In one case, we're on our third company with an entrepreneur, and for us, that's success. The vast majority of our companies continue to be first-time entrepreneurs. And if you look at the largest exits over time, they tend to be first-time entrepreneurs. It's super, super hard to come up and get everything right again. Product, team, market, timing. So if you look at companies like Microsoft, Yahoo, eBay, Facebook, you name it, all of them first-time entrepreneurs, generally under 30. Certainly there's an opportunity to create large companies later in your career. And in fact, I think sort of late 20s, early 30s is a wonderful time to be starting a company in terms of having the energy, having experience, but still having maybe some inspiration and naivete not to be held back by conventional wisdom. And I think that's one of the things that first-time entrepreneurs have, is that they sometimes don't know what they don't know, and that can be helpful in terms of looking to the future. And in general, that's why I find it helpful to be a little bit less focused on specific sectors, because I think entrepreneurs are the ones that sort of spot new opportunities coming over the horizon most quickly, and it's our job to work with you guys to have you educate and inspire us and bring us into the new markets. I think once somebody asked a question about big data. I think a lot of times, by the time people start using terms like big data, it's almost as if the term becomes meaningless, because entrepreneurs, the press, other people start throwing it around in such loose ways that it really could mean anything. What you really need to do is to define a category over time and own it. That's where the largest and best opportunities are created. And that's what I'd encourage you guys to do, is not to think about what sort of company and how you fit into the current environment, but also how you can create something that people will say, hey, they created the next, XYZ.
So just
Orrick, Sugarman.
Just two things on the due diligence before, because this area I'm somewhat passionate about. When you're talking with VCs, now assuming that no one in this room is formerly one of the first 5 employees of Facebook, So you're going to have like the first VC you call and wanting to put money in you. You're probably going to have to call on 10, 20, 30, 50 possible investors before you find the right fit. That means that there are going to be 9, 19, 49 rejections. So in the due diligence process, one thing that we like to do and one thing you should be seeking for is we would say, what is the most important or the 2, 3 most important next steps that you need to do to prove your case? And it might be a customer, it might be a channel partner, it might be someone you're really trying to bring on board. And then we try to help you find, as part of our due diligence, that customer, that channel partner, or otherwise, because if that possible customer says to us, no, this is really not an interesting idea, then that helps us because we can just reject without wasting your time or ours. If they say this is the best thing since sliced bread, it also becomes a validating point so that we can move forward. And then you've just gone 30, 40, 50 customer introductions that you didn't have to work for. So as part of your process of raising money, you've just advanced your business regardless of who ends up investing. So that's pretty important in terms of how you look at the due diligence we do on you. As you do due diligence on us, of course, the portfolio CEOs, the names, et cetera, but what you want to do is focus on the individual partner first. So who is going to be the person at that organization who you're going to have to live with when times are tough, you're going to have to sit across the table. Are they the person who builds consensus? Are they the person who's going to demand for change? What's their personal style like? And then in terms of the firm, try to find out the following questions. Where are you in your fund life cycle? If this is the last fund investment, it may be harder to get follow-on investment because there may be a lot of other fund portfolio companies you're competing with for that capital. Whereas if they've just raised a new fund, they might be willing to take more risk. So what is your typical follow-on reserve? So how much do you have if things are going well that you can keep putting in so I don't have to go back out to the market? What are the types of milestones you look for before you want to raise the next round? These are the types of questions you should be asking us because it shows to us that you're thinking about not just how do I get this bit of capital, but how do I build a sustainable relationship with my investment partner?
One final thing about that particular question, a bit of advice that I like to give entrepreneurs. When you do due diligence on an investor, try to talk to entrepreneurs who were in deals that didn't go well. Because if you talk to entrepreneurs in the deals that went well, guess what? Everything's sunny, everything's fine. When you talk to the entrepreneurs whose companies went under or were replaced, again, they may also be biased, they may have an axe to grind, but that's giving you the whole picture. So strongly recommend you do that. Now, there are so many questions. I saw the next question over here about 10 minutes ago.
Hi, my name is Sean. I have a question. 1 founder versus 5 founders. What is your perception and when you do your investments to the startup with the 5 founders?
Anyone?
I think, in general, I would say that's at least 1 or 2 too many. But if you can actually demonstrate to us that everyone has a specific reason to be here and is contributing, I mean, we're not the guys to tell you, okay, 2 of you get shot and then come back. But it's a question of honesty amongst the team as to who is the main contributor, who's the CEO, what the role distribution is, and so on and so forth. And very often what founding team fail at is when I have, let's say, 3 people in front of me, and I say, okay, what are you guys doing, and what's your main role, and who is the CEO? And they start looking at each other and saying, well, we haven't sort of really figured out, or all 3 of us, we're co-CEOs. And that shoots you big time in the foot. So it's a question of being honest to yourselves and who is there and going to contribute over the long run. And in my experience, when you start the journey at 5, not all the 5 sort of make it in the first couple of years.
I think in that scenario, it's super important to have founder vesting if you do go down that track, because there's a good chance that not all 5 of you will be left standing, whether that's because you choose to leave. Second is that I think there is some aspect that there are some questions, there will be a lot of dilution you guys will suffer if you're dividing the pie 5 ways to get started. And second is that there's a good chance as the company grows, there's oftentimes the role for, let's say, 2 founders to not have super strong functional expertise. But if you have 5 founders, what do? Because the CEO can be a generalist. You can have somebody who's maybe amazing at product or terrific with customers. But then it starts to get pretty murky because you actually do need a VP of marketing with deep experience. You need a VP of engineering that's run a team of 10, and you can't have every single founder need the type of mentorship that is required. You will need some additional senior execs. So I think that there is some balance. It's not an absolute no starter, but you want to think about what does this really look like 2 or 3 years from now.
I just want to underline what Mark just said. Founder vesting is an absolute requirement. And recently I had a company that we had 3 founders, 45, 45, 10, in terms of split of equity. And they didn't have vesting. And I said, look, I will not invest unless you put founder vesting in place. And don't even give me any reason as to why you don't want, this is it. And they did it. And 6 months later, one of the 45% founders is about to quit. And if ever we didn't have this founder vesting where he's going to leave, a vast majority of the equity on the table, we'd be fucked. Because suddenly we would have 45% of the equity sitting dead in the cap table. And so it's really, really important when you start this journey to be honest to yourselves and say, look, we're committed at this moment in time, but we don't know how things will be in 2 years or 3 years. And so putting that founders vesting is just the way for us to sort of recover from a founder saying, well, by the way, I just didn't want to do this. Yeah, sure. It's always, it's a standard 4 years.
All right, there's so many questions. I'm going to take one more question from this side of the room and one more question from this side of the room. So, how about over there? Just get his arm up first. We're going to hit the back of the room too, so you guys don't feel left out.
Keeping with the theme of the today's theme, what are some of the investments that you have made which 2 or 3 years down the road you go, what the fuck was I thinking? and a follow-on to it would be, besides a brain fart, what got you suckered into making that investment?
Excellent question. I don't know who wants to answer this one, though. I'm happy to answer it if no one else is, but it looks like Mark's willing to step up.
I think unfortunately, it's typically picking the wrong founders. I would say that in general, the most painful decisions have been where you've actually gotten the market right, and you just simply maybe overlook things. I would say in one of our worst investments, it was definitely, we saw what we wanted to see. The references probably weren't as strong as they needed to be, and we kind of ignored it. And we didn't really question, hey, why aren't they having somebody who really, really knows them and is B, is credible, and C, is willing to go to bat for them. And those are the sort of subtle signals that I think sometimes we as investors do ignore in our weak moments in the hopes of pursuing something big. I think when we fail with people that we respect and some of the assumptions turn out to be wrong and they're totally committed and they build a good team, those are the sort of investments that you can live with. You say, hey, we failed, we tried, we had a good time together, but when you pick the wrong team to work with, I think it's very painful for both the founders and the investors, and I think that really speaks to why sort of shotgun weddings are not the approach that you guys should be aiming for, because this is sort of like getting married. You have the occasion where you will have companies, and you read about it in TechCrunch, where it's seed funding, Series A, and exit within 12 to 18 months. But in general, if you're building something of substance, it's going to take 5 to 10 years. And these are the sort of people that this will have a lasting impact on the success of the company. And typically, investors can have a negative impact. And so generally, I try to live by a do no harm, even if you add no value. So.
All right, and one last note on that. I always tell entrepreneurs, you can't fire investors. You can fire employees. You can even fire founders. You can't fire investors, so keep that in mind. So in the back of the room, over here, got your hand up. Yes, I know. You've been standing, and so you deserve to ask your question.
Okay, right now I'm currently, I think one of you mentioned the incubator/accelerator program, and I'm actually not from the area, I'm from Hollywood. So I decided to go that route because I know relationships matter. So are there any specific incubator or accelerator programs that you guys deal directly with or get some of your investors? I know like right now I'm waiting to hear back from one of them, so I wanted to find out if there were a couple that you guys deal specifically with.
Okay, great. So which incubators and accelerators have you tended to work with the most? And don't worry, I won't report back to them what you say.
So at the end of the day, we're happy to work with the good incubators, and for us, the good incubators, and this is really important for you as well, are the ones that attract really great mentors. And when an incubator pitches me about joining their demo day, the first thing I do is to look at their mentors and see whether those are people who I think will be credible at helping companies. In terms of our own involvement, we've done 6 YC companies, 5 Techstars. We've done a couple of Angel Pad companies, big fans of Angel Pad. We're friends, you're from LA, so we're friends from Science. Mike Jones and Peter Pham are doing excellent work in the next-gen e-commerce world, which is very close to us, so we'll be working very closely with them. I mean, at the end of the day, we want good people who really have a genuine track record at helping build companies, and then, work with them and help them.
Okay, fantastic. So with that, I'm going to draw the first Silicon Valley Reverse Demo Day to a close. I'm sure that we'll bring Chad Lynch back up to the front to talk a little about Orrick, and they'll be handing out various evaluation forms. Remember, if you enjoyed this event, be sure to give it good evaluations, and then we'll bring back this cast of characters, Dave McClure, a lot more swearing, and everyone have a good time. So again, thank you all very much for coming in.